But our focus this hour is what's ahead for stocks in the second half of the year. Meghan, why don't I start with you? What do you think?
Well, we're still optimistic. We've had a great start to the year, a great first half. We think that there's further gains to be had for equities. I don't think it'll match what we've seen over the last 6 months or 12 months, certainly. But we are still constructive. I think it'll be really important to watch what happens with interest rates and that 10-year yield. Today's move, I think, is counter to what we expect over the next 12 months. We do see interest rates moving higher. We see the global economic recovery continuing, and we think that's a really solid backdrop for cyclicals and value, where we have a slight overweight in our portfolios. We're overweight to equities more broadly, and we are still constructive. There might be some choppiness ahead, but we would encourage our clients to look through that and use that as a possible buying opportunity.
Joe, as you look to the second half, what do you expect, and what will you be watching?
Well, Tyler, Meghan mentioned yields, and that's exactly where I think you have to begin the conversation. Tyler, can you find anyone that believes yields are going to continue to move lower? A 10-year Treasury is actually going to approach 1%. So I think the conundrum, the puzzle really is figuring out, why is a 10-year Treasury trading at 1.43%? Why did the U.S. dollar rally 2.5% this month alone? That's really going to dictate the roadmap for the second half of the year. And if you're looking at investment grade and high yield, and you're looking at the spread over Treasuries, what you'll find is investment grade, the spread is at its lowest level since 2005. High yield, the spread is at its lowest level since 2007. So who's going to go and actually capture that yield? There's no appetite. There's no sentiment towards continuing to be in that fixed income trade. And to me, that's very puzzling. You had Paul Jones on the network 2 weeks ago talking about inflation. Where is the inflation? Where is it reflected in Treasury yields? That's the roadmap for the second half of the year. I think you'd be invested in equities, but how you do it is going to be absolutely dependent upon where these 10-year yields go.
And what do you think those yields will do? I mean, it is puzzling if there are inflation aromas in the air, why the yields are coming down, why the spreads are narrowing like that.
Listen, it's fascinating. And Tyler, I think if we conducted an exercise where we were to ask 100 so-called experts on where they think the next 25 basis points would be for a 10-year Treasury, I'm pretty sure the overwhelming majority would say it's going to be closer to 1.7 than below 1.20, right? But yeah, unfortunately, the current trend is pressing lower towards 1.20, and we have to understand or realize, why is it pressing towards that low? It's more than the Federal Reserve continuing to buy treasuries. Is there something going on with the Delta variant? Is there something going on external to the U.S. that's troubling markets where they're seeking that safe haven demand buying? That's the puzzle. I don't have the answer.
Amy Raskin, do you have the answer?
I'll try. I'm not sure I have the absolute answer, but I definitely have some views on this. I think a lot changed when the Fed changed their tone about inflation and brought up the dots to 2023. I think what that message was, that we were not going to let inflation run wild. And I think what the market is telling you is that inflation is going to come in hot, and the Fed is going to have to act sooner rather than later. So what you saw when that happened is that the short end of the curve went up, but the long end of the curve came down. So, which is what you would expect with the Fed saying we're not going to let inflation run away. So I do think that that does favor the growth trade. With regard to the markets generally, we continue to make new highs, but under the hood, the technicals don't look great. You're not getting a lot of breadth. You're not getting a lot of confirmation from 20-day highs. You have maximum allocation to equities for households right now. So there's a lot of optimism in the market currently, and you are seeing sort of a breakdown of the technicals underneath. The other thing that I would add is growth is going to slow. We're probably at peak growth right now.